Greetings everyone, Quantum Unicorn here. Welcome to my channel. If you haven't been following along with the video so far, then I have a link in the description section below that links to where you can download all the data files so you can follow along with this. Okay? And please subscribe to my channel, like the video, and click the bell icon on to receive the latest updates. Thank you. In our last video, we built a simple trading strategy based on MA10 and MA50. Overall, during the investment horizon, this strategy makes about $145. It's good, but not good enough. As you can see from the chart, there are two major setbacks we wish to avoid. In statistics, MA10 and MA50 are random variables. Random variables play an important role in helping us making better market predictions and investment decisions. A random variable is a mathematical formalization of a quantity or object which depends on random events. Random variables are often used in econometric or regression analysis to determine statistical relationships among one another. Key takeaways. A random variable is a variable whose value is unknown or a function that assigns values to each of an experiment's outcomes. A random variable can be either discrete or continuous. The use of random variables is most common in probability and statistics, where they are used to quantify outcomes of random occurrences. Risk analysts use random variables to estimate the probability of an adverse event occurring. In finance, random variables are widely used in financial modeling, scenario analysis, and risk management. In financial models and simulations, the probabilities of the variables represent the probabilities of random phenomena that affect the price of a security or determine the risk level of an investment. There are two types of random variables: discrete random variables and continuous random variables. A random variable that takes on a finite or countable infinite number of values is called a discrete random variable. A random variable that takes on a non-countable infinite number of values is continuous random variable. Here are a few real-life examples that help to differentiate between discrete random variables and continuous random variables. Consider an experiment where a coin is tossed 3 times. If X represents the number of times that the coin comes up heads, then X is a discrete random variable that can only have the values of 0, 1, 2, or 3 from no heads in 3 successive coin tosses to all heads. No other value is possible for X. An example of a continuous random variable would be an experiment that involves measuring the amount of rainfall in a city over a year, or the average height of a random group of 25 people. Drawing on the letter, if Y represents the random variable for the average height of a random group of 25 people, you will find that the resulting outcome is a continuous figure, since height may be 5 feet or 5.01 feet or 5.0001 feet. Clearly, there is an infinite number of possible values for height. With that being said, stock prices are discrete random variables because they can only take on certain values, such as $10, $10.01, $10.02 and not $10.50, since stocks have a minimum tick size of 1 cent. So, by way of contrast, stock returns are continuous, not discrete random variables, since a stock's return could be any number. So a random variable has a probability distribution that represents the likelihood that any of the possible values would occur. Let's say that the random variable z is a number on the top face of a die when it is rolled once. The possible values for z will thus be 1, 2, 3, 4, 5, and 6. The probability of each of these values is 1/6, as they are all equally likely to be the value of z. For instance, the probability of getting a 3 when a die is thrown is 1/6, and so is the probability of having a 4 or a 2 or any other number on all 6 faces of a die. Note that the sum of all probabilities is 1. Let's now move beyond the theoretical discussions and delve into practical applications by developing a simple dice rolling game using Python. In this game, our objective is to compute and record the sum of face values of 2 dice, each of which possesses 6 faces with 6 values ranging from 1 to 6. We will employ the pandas method sample to stimulate the game and enable Python to calculate the sum of the 2 dice. With each iteration of the code, you will receive a unique number of value. By rolling 2 dice 50 times, we will generate 50 observations, whose sums we will add together. For our example, we will print the first 20 observations of the 50 trials. It is entirely typical for multiple observations to feature identical values as we roll the dice independently during each trial. The sum of the 2 dice, represented as x, qualifies as a random variable whose outcomes we cannot predict until we roll the dice. This random variable embodies the inherent unpredictability of the game. Nonetheless, we can have certainty about the collection of possible outcomes, ranging from 2 to 12. These outcomes do not possess any randomness, as they arise from the realized or observed values of x. Each outcome falling within a finite range of values presents an equal chance of occurring. Thus, we categorize them as discrete random variables. That's all for today. Congratulations on finishing this tutorial. Please subscribe to my channel, like the video, and share it out. If you have any inquiries or concerns, feel free to reach out and leave a comment. In our next video, we will learn more about random variables. How exciting! Well, thank you for your time, and I look forward to connecting with you soon. Goodbye.